Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And we're back. Like it or not. Had a great week, actually. And not because of the stock market. In fact, I think a lot of people are surprised that most days I don't really look that often at the stock market. Maybe only 4 or 5 times. Yeah, for me, that's not a lot. But and there are actually complete days where I don't look at it at all. Mainly depends on what I have to do that particular day. Because I've already got all my methods are in place. They're not going to change because I get a feeling or because England is leaving the EU. As we've seen, everybody that panicked and sold is kind of sorry now. And because we've already planned for that beforehand. In the plans, in the investment management plans that we have, we are planning for unforeseen events. Now, you're probably thinking, how do you plan for something that's unforeseen? Well, you just expect things like that to happen. Markets are going to go down, they're going to go up. And you make your plan so that you make the adjustments when you need to, so that you don't have to think about it. You know what you're going to have to do before it happens. That's a key. You got to know what you're going to do in response before it happens. A couple reasons for that. First of all, not doing that is going to probably cost you money because you're going to make bad decisions. You're going to make emotional decisions. You're going to make decisions based upon short-term price movements, and that is a horrendous way to manage your money. But more importantly, you get a mindset that's peaceful. And I guess these two things really go hand in hand. Peaceful mindset because you know what you're going to do in response. You already know what you're going to do. So, and all you're really doing at that point is waiting, monitoring, and making the changes as necessary. How cool is that? And it's really not that difficult, and it's what we're going to be talking about at this workshop coming up here. It's actually August 13th. It's a Saturday morning. The title of the workshop is How to Generate More Income from Your Investments. We're going to be talking about using dividend-paying stocks. We're going to be talking about using high-yield bonds. We're going to be talking about using other types of income-producing assets in addition to CDs and treasuries. They still have a place in your portfolio, mainly to control the volatility. It's not that you're going to make much money with them, not at current interest rates. And I'm going to show you why you should not be investing in long-term bonds and how to determine whether or not the portfolio you're invested in is in long-term bonds. I guess that's probably one of the things that I'm seeing now. When I see the proposals and I see other portfolios from other portfolio managers, mainly institutions, they know what you want to hear, by the way. They know you want to see an interest rate that's higher than the 2.6% that you can get on a 30-year treasury or the 1.6% you can get on a 10-year treasury. They know that. So they're going out and they're finding stuff that has higher yields, and then they try to dress it up to kind of gloss over the risk that you're taking. And that's a bad deal. That's just a bad deal. I see it. It's never changed. People used to complain about the stockbrokers. There are studies that show that people that have a traditional old-fashioned stockbroker actually are doing better than the people that are trading through an online broker. Yeah. You know why? Because they talk to somebody who actually knows something about financial markets. You don't really have to know anything to pass your Series 7 exam, the stock broker's license. You don't really have to know that much. You just have to know the answers to the test. Most of them are memorized and not understood. So what you get are a lot of things that are created, a lot of products that are created just to appeal to what they know you want to see and then they kind of gloss over the risk that you're taking to get that higher rate of return. Well, I'm going to show you what that is. In fact, I've got a book I'm working on, a booklet. It's paper, really. And it's going to show my high dividend model. The paper's going to show the high dividend model. I'm going to show an example of it at the workshop. I'm going to put it up on the screen. Why am I doing that? Because I want you to know. I want you to see how the performance of one of the better performing stock investment models does it. How is that achieved? What are the actual workings behind the scenes? So I'm going to pull the curtain back and I'm going to show you everything. And it is fascinating. It is absolutely fascinating. And I think more people, if they were given the opportunity to see something like this, it would improve their ability to withstand a decline. It would improve their ability to stay put, make the adjustments when necessary, or allow their advisor to make the adjustments when necessary because they see it's part of the program. That's actually how it works. When you see the performance, all you're seeing is what happened. You're not seeing you're not seeing how it happened. And oftentimes, I'm going to tell you 99% of the time, people just look at the results and they go, oh, yeah, that's what I want. And then when they're in the middle of things, the thick of things, and they actually are experiencing how it happens, an awful lot of them say, whoa, I didn't sign up for this. Well, yes, you did. Actually, you just didn't know. You didn't know that you'd signed up for that. So I'm going to pull the curtains back and give the book. I've been working on it. I just got the research part of it done. Now I'm just doing the writing. And the research part of it is showing each and every stock that would have showed up in this particular strategy over the past 10 years, each and every stock. This strategy rebalances once every 12 weeks, every quarter. Many of you are going to recognize it as my high dividend model. Okay. So at the workshop, we're going to look at the high dividend model. And by the way, the current yield on that model is right around 5%. The current yield's 5%. I had somebody, the reason I'm pointing that out, somebody was saying, well, there's a whole bunch of dividend models. Yeah, there are. Some of them are good. Some of them stink. Some of them you'd be better off in the S&P 500. Like a lot better off. So you've got to know the differences. And we all have a tendency to want to make this easy. And a lot of it's relatively simple. But you can take it too far. When you look at the dividend achievers, the yield on that thing's like 2%. 2%. The total return's pretty decent. I get the strategy. I'm not fond of market cap weighting. That's why I don't use that, the dividend achievers. If I really liked it a lot, I can use it. And I think some people don't understand that about Bullington Capital either. You have an idea, an investment idea. You want to include it in your model. You can do that with us. We can customize that for you. We can, and we will. And I'll definitely do it because I get to show that right next to my models in the same account. They will be tracked independently of one another and in completion if you add everything together. So you get to see the portfolio account value, the whole thing. And then you can break it down into the components, each one of those. So if you want to see the dividend achievers and you want to lay that against my high dividend model, I'll take that big time. Not afraid. And we're, like I said, full disclosure. We'll show you everything. So we're going to be talking about that at the workshop. And by the way, that's August 13th. It's a Saturday morning, 8:30. I won't be able to talk as long as I normally do because I have to come here and do the radio program after that. So, which is probably a relief to those of you that know me. And just feel free to go to the website, sign up, or you can call us 330-664-0700 if you don't have access to a computer. And you can sign up. There's no cost to attend. I got to tell you, the corporate college has done a wonderful job over the past couple of years. There's been some management changes there. They brought in some 4- and 5-star chefs. They have a phenomenal continental breakfast there. They bring out smoothies made with Vitamix, one of my favorite local companies. I got a ton of those products, by the way, the Vitamix products. They got this new one I'm dying to buy. Yeah, but I don't know if I should. I've given away at least a dozen of those, at least a dozen Vitamixes. And those of you that know how much those cost know how much I've just given away as gifts, because they're just it's a great product. And they're made right here in Northeast Ohio. One of the better investments I think you can make. It costs significantly more than a regular blender because it's worth it. You can put anything in there. It'll turn it into either powder or a puree. I don't care what it is. Yeah, make your own ice cream in there. Anyway, I'm getting off the subjects. But you can come there, and we're going to have they're going to put out some smoothies made with Vitamixes right there. So pretty cool. Anyway, it's Bullington Capital. Sign up on the seminar site. Should be a lot of fun. By the way, if you have a phone call, question, or comment today, you can call us, 216-901-0945. And I had a guy call in last week, and this guy calls in fairly frequently, and he was complaining that somebody with $1 million has to pay the same percentage as somebody who only has $500,000. And I was thinking about that over the week, and it's interesting. So I guess, part of what he was saying is somebody's got $1 million. It's just as easy for a guy to manage $500,000 as his million. Why is he paying $10,000? Let's say he's paying 1%, and the other guy's only paying $5,000. Well, it's because he has twice as much money. And see, that's how percentages work. When you're putting more money in, it goes up. And don't think it's that much easier. It's not. I promise you. And I can tell you from it's a cold hard fact. Last 30 years I spent in this business dealing with people who have larger amounts of money. They tend to take up more time. They do. That's just the way it works. Why should I give them a break over somebody who's not taking as much time? And by the way, I do. And it's called the more an asset somebody has, I give them a break. But mutual funds don't. Mutual funds don't give them a break because for them, that's just basically how the business runs. And why should somebody be prejudiced towards somebody who has a lot of money and give them favors? I mean, come on, really? So, and it's fair, and it's actually the way the business runs. And I also have a fund, by the way, that charges no management fee, and I have made no money on that fund in the past year. And I've been working my hind end off because it's the last 12 months have been pretty rough. Markets, you hear the market, it's an all-time new high. Yeah, by 0.5%. And it was down 10 or 12% from peak to trough. It was down in the mid-teens over the past 12 months. So, and I have a fund, and if you have enough money, if you've got $1 million, you can get in the fund, because that's the SEC's rules, not ours. They govern this whole show. And there's no management fee, and there's only a percentage of the profit. If there's no profit, I don't get paid. Okay? So I do have an option for that. I've thought about that too. And incidentally, you can save yourself a lot of time, effort, and energy when you're looking at a mutual fund or an exchange-traded fund's performance. It already has the fees factored in. So if you want to just cut out that loop there, fees only count when you're looking at two identical strategies. And obviously, if they have identical strategies, one of them is going to have a higher return than the other if it has a lower expense ratio. Now, having said that, looking at the past performance of any investment strategy, it's something you want to do, but it's not the first thing you want to do. The very first thing you want to do when you're looking at investment strategies, like we're going to be talking about at the upcoming workshop, is what are they doing with the money? That's most important. That is the most important item. What are they doing? What is the manager doing with your money? Can it be explained in under 2 minutes? Peter Lynch, for those of you that don't know who he was, this guy had a mutual fund track record nobody's ever matched. 13 years, over 30% a year. That was his average annual return, by the way. Market had 9 corrections of 10% or more while he was running it in that 13-year time period, and every time he was down by 9% or more. We'll come back to that later. But I did it again. I lost my train of thought. Anyway, we're going to have the workshop there. We're going to talk about those types of things. The fees that are involved should be third or fourth on your list, and you should only be looking at them when you're comparing two identical strategies. When you're looking at two identical strategies, it obviously, you're going to want to go with the cheaper one. That's an easy one. Okay? But if they're not identical, you got to find out what are they doing with the money, because it may justify a higher expense ratio. It might. Absolutely. I can tell you that the trend following commodities guys, those guys they charge a ton of dough. And they won't make any money for a very long time. And then occasionally they'll knock the lights out. And if you look at their average annual return, you go, wow, that's huge. Yeah, well, it's also very expensive if you want to. I'm sure that kept a lot of people from investing in that and enjoying the benefits of that. In fact, the guy that owns the Boston Red Sox was one of the bigger, and it actually grew so big he had to shut his fund down. He couldn't do it anymore. He got too big. Can you imagine that? Can you imagine managing that much money? You get so much money that you're actually moving the market around every time you buy or sell. That's crazy. But it happens. It happens a lot. It doesn't happen as much in the stock market as it does in commodities markets. And commodities markets have changed over the years. Those same strategies haven't made nearly as much money as they used to. But, that's all other things being equal, you want to look at what they're doing with the money. That's the key. Look at what they're doing with the money. It should be fairly easy to understand. If it's not easy to understand, my suggestion is move on. Don't take their word for it. Find something else. If it's too hard for an average 12-year-old to understand, I would move on. I would look for something else. The models I run, they're incredibly simple. There's a reason for that. Big reason for that. Which brought me to something. I remember circling back to the breakpoints. That's actually what the guy was referring to. There are breakpoints. Some funds actually have breakpoints. If you have more money, they do give you a break. So you have to check the prospectus. But again, it comes back down to what are they doing with the money? And here's something I'd like to just touch on just a couple minutes here. I think we're going to be going into commercial break pretty quickly. So the economy and the stock market have very low correlations, which means, and causations. The stock market and the economy are not highly correlated. That means one does not necessarily follow the directions of the other. In fact, there's an awful large part of the time where they don't. And I know we're going to have a commercial break here pretty quickly. So, actually, there's the music. Hey, you're listening to Bill Bullington right here on 1420 The Answer. Feel free to give us a call, 216-901-0945. After these messages, I'll be right back. And we're back. That's some funky music. Anyway, hey, give us a call, 216-901-0945 if you have any questions. We were just talking a little bit about the low correlation between what goes on in the economy and the stock market. The vast majority of people still believe, I guess I shouldn't say the vast majority of people, I should say a lot of people still believe that whatever happens in the stock market's immediately reflected, in the economy is immediately reflected in the stock market. And it's only because they haven't had the time in their lives to stop and check those facts out. The stock market tends to be a barometer, and it tends to be 6 to 9 months ahead on average. Averages have a lot of variability in them, but on average, somewhere between 6 and 9 months ahead of the economy. So if you're waiting for the economy to turn up before you get invested in stocks, that's one of the classic biggest mistakes the average amateur investor makes, is waiting for the economy to improve. The economy tends to bottom after the stock market has bottomed by several months, sometimes a year or longer. So if you're waiting for the economy to turn up before you get back in the stock market, you're toast. The market moves up dramatically while you're still waiting for the economy to improve. Let me give you a point example, something we're going over at this workshop on the 13th of August. I never say anything that I can't back up, by the way. If I can't back it up, and I don't say it. So if it's not true, it's because whatever sources I've checked, normally they're multiple, okay, the sources are wrong because I never say anything that I haven't read somewhere else. I just have more time than you do to work on this kind of stuff. That's why I tend to know more than the average person's going to know. It's just a time thing. I spend a lot of time doing it, and I'm passionate about it. I like to spend a lot of time doing it. So anyway, the economy turns up after the stock market has turned up. So if you're waiting for the economy to improve before you invest, big mistake. Don't do that. In fact, if you look at the stock market, 2009, go back to 2009. Remember everything was in the toilet? There were 2 quarters back to back when the markets finally bottomed out, when the S&P 500 finally bottomed out and started to turn back up again. The economic data was getting worse. The economic data was actually getting worse when the stock market turned up. A high dividend model in the 2 quarters after the market bottomed was up over 30% each quarter. Think about that for a second. It was up over 30% each quarter. And that's going to be in the information I'm going to be presenting at this workshop. I'm going to show you that. And I'm going to show you how, if you really want to do it, you can go back and check that stuff. You can double check everything I'm telling you. Because we don't believe in partial disclosure at Bullington Capital. We believe in full disclosure. You need to know. You need to know everything, the good, the bad, and the ugly. Because if you don't, if somebody hides the ugly and tries to sugarcoat it, you're going to get upset, and you're going to be like an average investor, and you're going to pull. When things look the worst, you're going to pull. So far this year, actually, I don't know if we're allowed to say that, but look at the, I'll have to double check and come back to that. But this year, the high dividend model has done very well, extremely well. I had people pull out. Actually, I had people pull out during the Brexit thing. Couldn't be consoled. They had watched too much of the media. They let it get to them, and they pulled. And it happens. It's going to happen. Look at the average investor's results over their last 20 years. They're horrible. They're absolutely horrible. They're less than half of what they should be making. Less than half of what they should be making. Actually, the average investors averaged about 2.5% a year, according to Dalbar. That's the company that studies investor behavior. In fact, their new report's just out for this year. I just ordered it. I should have it by the time actually, I should have it by next week, but so we can talk about that too. And I'm telling you, it's just you got to be familiar with how markets actually work. And for people that dabble in it, dabbling in stock markets, like saying, well, I think I'll go get a flight instruction manual. I'll go fly a plane this weekend. Really? That's what you're going to do? And I know if that was allowed, by the way, airplane crashes would be much more frequent. But they don't allow that. You got to have a real pilot on board, someone with some experience who spent a lot of time studying. I've never had time to finish that the training. I've only got 10 hours total. So those of you that do fly know that's basically nothing. Slightly more than someone that's never been in a plane before. But anyway, with investing, there are an awful lot of things that come up that are counterintuitive. And people suffer from all kinds of biases, by the way. The market's pretty crazy. You look at the amount that stocks move up and down. You look at the stocks in the dividend model. And that's actually what this book is about. Look how they move. Look at a lot of the stocks that were purchased in the model because they met the criteria. And by the way, when you have an investment model, it has a few attributes. Those are, what do you buy? When do you buy it? Not based on a feeling or gut feeling. When do you buy? Give me a definition. When do you sell it? Also needs to be clearly defined. What percentage of your portfolio do you put in it? Now, I know for the vast majority of people that takes all the fun out of investing. And you know what? Investing shouldn't be fun. It should be like a job because you're going to rely on this for income one day. It should be like a job. I happen to think it's fun anyway, and I love watching the stocks that come up in the picks, in the models. See, all the thinking goes into building the model. That's where you should be doing your thinking. You shouldn't be thinking about, should I be buying or selling this stock? I know it's fun. So is betting on football games. It's fun. Not very profitable for the most of us. And so if you like, I don't bet on football games, by the way, because you know what I learned a long time ago. It's not very profitable. It's fun to speculate on who you think might win, but I've learned not to put any money on that because I'm wrong too many times. You can't make money gambling. Houses can because the odds are in their favor, but the average person is not going to make money going to Vegas. The average person is not going to make money betting on football games. The average person loses money in the stock market. Why? Because they don't have a clear strategy. You got to have a clear strategy. You got to know what it is. You got to know the good points. You've got to know the challenges of each strategy. There is no easy. When I'm talking about easy, I'm talking about psychologically, because the math involved in a lot of the models that I run is incredibly simple. Is it labor intense? Yes. If you do not have a good screening tool, it's going to be labor intense. I promise you that. It will be labor intense. But which is one of the reasons I have a job. That's why I just don't teach the strategies. Because and I will if you want me to. I can arrange classes for you. You can come in the office. I'll do it. It's kind of expensive, but I'll show you how to do it. You'll be able to take that skill with you for the rest of your life. And it's expensive. You're talking $3,000 or $4,000, and I'm going to work your butt off. By the way, I'm not going to do all the work. I'm going to show you how to do the work, and I'm going to make sure that you're doing it correctly. That's a big deal. If that sounds like a lot of money to you, well, then don't do it. This is America. Who cares? You don't care, neither do I. Yeah, but I'll do it for you. I spent $10,000. I don't know how many times on a weekend seminar. And you know what? Were they worth it? No, not all of them were. But I knew I got at least enough out of each one of those to justify the money that I spent on it. And that's kind of how that works. I'm not suggesting that you should do this because I think it's easier. And part of the reason that you have an advisor is to have somebody to talk to ask questions to. You're going to forget. I promise you'll forget. One of the reasons I'm putting this book together, and my clients are all getting it for free. Okay, the clients are going to get the book for nothing because I think it's something that it's a very important tool to be able to have in your arsenal to go back and look and review, just to remind yourself. Because doing the right things is not always easy. Doing the right thing is not always easy. In fact, it's oftentimes challenging. And 95% of your investment success is going to come from being able to follow the plan that you laid out for yourself. 95%. That means 5% is the actual plan. Yeah, that's the way that works. Ask anybody that's ever competed in a competitive sport how psychological that stuff is. How much harder it is to do if you're a golfer and you're playing in a big tournament and there's a whole bunch of people watching every drive, every stroke, every putt. Significantly more difficult than when you're doing it by yourself. That's actually one of the benefits of investing, by the way, because you don't have to talk to anybody about it. And you don't have to show them your results. You can keep that to yourself if you want to. So it's minus that stress. You don't have that, but you still have to know what's going on and know what to expect. And it's a learned behavior. I promise you, it is not natural. It's not natural to want to add money to stocks that are dropping. That is not natural. The natural thing to do there is to hang on and hold on to the loser and hope that it comes back one day. Another natural thing is to sell your winners too early. Okay, that's a natural thing. So you've got to decide. That's why you have to come up with a method, a checklist, basically. I mean, think about that. A checklist. How easy would that make your life? Here's a checklist. And then this is basically one of the reasons I have a job is because I have a checklist. I have several checklists. I have 3 models I like a lot. One I happen to like more than the others, especially over the past few years, and especially the further that I've looked into it. The more I've investigated, the more I realize, holy cow, I should have been doing this. And hindsight's always 20/20. But and I know it's the dividend model. And I have a client, by the way, who made a phenomenal call. She actually had me overweight the dividend model in her portfolio before I did anybody else's this year. And she has reaped the benefit. She was early. And she did better than I did. Actually, she's doing better than I am. Because I held on to a lot of the other things. Will I catch up at some point in time? I think I will. I'm pretty sure I will. But in order for that to happen, GDP growth typically has to be pretty fast. It's got to be above 3%. You don't have GDP, you don't have an economy that's expanding really fast. Your growth strategies tend not to do that well in that environment. And since this is actually the slowest recovery we've had since the Depression, definitely in my lifetime, it's kind of set a record. Modern day finance, slowest recovery from a recession. I would have expected that there would have been a faster recovery because it's never taken this long before. And so the momentum models haven't done quite as well. I don't think that they've stopped working. I think that the environment hasn't been conducive to it. And at some point in time, I got to believe the environment will be. There are a ton of industries that are they're on the edge of rapid expansion. And they're very big. And think about all the highways, roads, and bridges. A lot of that money's been allocated, by the way. They haven't started spending much of it yet. It's started to work its way through the economy now. Look at the grid. There's a story in today's Wall Street Journal talking about the grid, how much it needs to be upgraded. And it does. Actually, the public utilities in the United States, a lot of them are, over 100 years old. That stuff needs to be replaced. It's not as effective as it could be. And you're talking about trillions of dollars of GDP. So when do they get around to doing it? It's not if they're going to do it. They're going to have to do it sooner or later. Because sooner or later it breaks. Okay? So and just fixing it is going to get more expensive than just replacing it with new stuff. So sooner or later that stuff starts to happen. Sooner or later a lot of things change. That's one constant you can count on in your life is that it's going to be change. Death, taxes, and change. 3 things you can count on. So anyway, I've been talking here for almost 40 minutes straight. Feel free to call us, 216-901-0945, 216-901-0945. And we got I really like the workshop we got coming up. I've got this booklet. I've started to pass them out. Shows you behind the scenes inside the portfolios, what actually would have gone on in your portfolio had you been using this particular strategy over the past 10 years. You see the good, you see the bad, you see the ugly. What was really surprising to me when I was looking at this, and I looked at it from a much different perspective. I was looking at the actual end of period performance prior to this. So now I've dug deeper. Went in and said, okay, what happened to each and every one of those stocks that I hold over the past few years at each quarter? The beginning of each quarter started at 0. What happened at the end of each quarter? And it's pretty eye-opening. And it's amusing. And it's relieving. Comforting, even. So you need to get there. You need to get to the workshop. Like I said, as soon as I get the text finished, I have the research finished. When I get the text finished, clients get a free copy. I'll put it up online. I'm going to make it cheap. I'll make it inexpensive. Just about anybody will be able to afford it. I'll put it on Amazon.com. Yeah, so very fascinating. And I really believe this is going to help an awful lot of investors out there. They're going to be able to relax. They're going to be able to have more confidence in what they're doing. And you should be confident in the economy. You should be confident in our government. As slow as things have been going, there's still been an awful lot of positive progress. Is it as fast as we want? No, it's never going to be as fast as I want it. Okay. But there's still progress there. And there's still ways for you to be able to make money. Lots of ways. In fact, when I come back from the commercial break, I'm going to talk a little bit about the valuations on the S&P 500. Some people have been expressing concern about that. I want to deal with that when we come back from these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned.
Puppy mills are mass breeding facilities that crowd hundreds of dogs into barren cages with little regard for their welfare. There is a bill being presented to the Ohio General Assembly that would strip communities of their right to say no to stop the sale of puppy mill dogs. Senate Bill 331 and companion bill House Bill 573 would even write in the law that pet stores could acquire dogs from completely uninspected, unregulated commercial dog breeders. Say no to puppy mills and radical legislation. Ask your state House of Representative member to oppose assault on animal cruelty laws and local governments.
And we're back. Going to take some questions right now. You have a question, 216-901-0945, going to Jerry and Solon. Jerry, how you doing?
Good morning, William.
How are you?
I have a question for you, sir.
Sure.
It involves selling puts for income. Obviously, you would not want to do this with a extremely high beta stock, but something, say, a Cisco, an Oracle, something of that nature.
So you
blue
picked
chip.
two of the most high beta stocks to say don't use a high beta stock on?
Well,
Dude,
come on. They're not.
no,
they're
come
not
on.
as high
You
as
come
some of the
on.
other ones.
Cisco, look at Cisco 15 years ago. Okay, 16 years ago, actually. It was $82. It's $29 today. That was 16 years ago. So you need to pick a different stock for that.
That's true.
Yes.
However,
No, there's no however.
16 years ago, it hasn't. Look at its fluctuation within the last several years, and it's generally within 80%. It's not significantly.
Well,
it is not a.
It's still in a business that has dramatic change constantly, and they constantly have to develop new products. So their R&D budget as a percentage of total revenue is huge, which means their profit margins are significantly lower than they have been in the past and under fire constantly. So for those types of stocks, I would say no, that's not a good thing to do. Yep.
Well, I had heard that Cisco and Oracle were the new blue chips where they're starting to pay dividends.
Well, listen to what I just said.
Growth.
Listen to what I just said. You look at the R&D that's required as a percentage of their revenue, and it's humongous. And their product lines are constantly shifting, and their profit margins have shown a steady decline. So those types of stocks, no, I wouldn't agree. I think if you're doing it with the right company, say Procter & Gamble, okay.
Procter & Gamble, Colgate.
Yeah. Well, Colgate's actually a little overpriced right now.
It's gotten pricey. That might be the time to sell it.
No. When you sell a put and the stock is overvalued, there's a good chance the stock is going to go down. You're going to be buying that stock at a higher price than you could go around and just buy it for. I would probably do the covered call on that rather than the covered put.
I've done that. I got taken out of it because I sold them at 70. It's 74 now.
Well, that's great though. That's great.
It's had a nice little run. I mean, I originally got into Colgate because it was by selling puts. I got in at a low price. I wrote it up and then sold the calls against it. And eventually, after several times, it did finally get called. So I mean, you're not going to get rich on it, but it's nice, steady income.
Well, it's not nice, steady income. The income's constantly fluctuating, and so is the share price. And at some point in time, you'll see a giant drop. And that's actually one of the things I wanted to talk about today. The S&P 500 has got a price-to-sales ratio of 2. That's right around that's pretty high for the S&P 500. It's substantiated by the current profitability of the companies, but they've been buying shares back with both hands. So
Colgate has.
No, they all have been.
They all have, but Colgate specifically has.
Yes, and that artificially raises the earnings per share. That's not due to increases in sales. Okay, so they're not increasing their market share. They're actually buying back shares to try to get the earnings per share to go up, because those are the numbers that all the bonuses are predicated on for the people that work there.
Right. Oh, you know who they're after.
Yeah. Well, so that's what I'm saying. And with the S&P 500, there's a huge dichotomy between the upper level, upper echelon, the blue chips, the valuations on the blue chips, and all the others. A lot of the stocks in the S&P 500 are selling below a fair price to sales ratio, because companies like Colgate, Clorox, Sherwin-Williams, the really bluest of the blue chips, are at valuations that are probably 15 to 20% higher than they should be. So if you're selling puts on those, I think that could end up being pretty bad. You're going to get the stock put to you. You get $1 for the put income, and then you lose 10 on the share price. So from this standpoint, I probably wouldn't do that on those types of stocks. I think it really depends on the stock that you're looking at.
Okay.
Yeah, and you got to be really, really careful with that one. But I like the idea, and in this environment, yeah, if you're doing it the right way, I think you could probably be very profitable with that. In fact, I would do. There's a gentleman that brought this up. I'd sell the put and the call. You could sell
the
them.
call, yeah. Put a collar of some sort on it.
Yeah, well, in that case, it actually increases the range of prices the stock can close in, and you'll still be profitable while keeping your profits. So, and you get to keep the if you do it with a covered position, then you get to keep the dividend too. So there's
right. Well, where is Clorox now? You say that's selling above where it probably should be?
Yeah, and
I haven't followed that in a while.
Yeah, and actually, I don't have my Y charts up right now, because I just remember looking at it a few days ago and going, oh, man. And that's when people say the stock market's overvalued, they're really talking about the blue chip companies, because if you look at the valuations on most of them, they're a little high. They're a little bit high. Fortunately, that's not the entire stock market. If you looked at the average stock, and the average stock has price to sales ratio of 2 or higher, then oh man, this is probably going to be rough for a while.
Right.
Yep. But I like the idea. And it's good. It's shows that you're trying to think and thinking outside the box. But you just have to be really, really careful with the stocks that you choose to do that with. I would much rather do that on stocks that have made 52-week lows where the sentiment is horrible.
I was just going to ask you about that.
Yeah, because
but one of your thoughts is that if it can go bad, it can always go worse, though, right?
Well, if you're going to do this, I would look at the valuations on the stocks.
Okay.
Look at the stocks that have just crashed, and look at the ones that have good, solid balance sheets, where people may be overreacting. So here's one of the screens that I would use. I get your telechart out. Look at the stocks that have twice their average daily range and twice the average daily volume nearing a 52-week low.
Okay.
That would be a good one because now you're being the true contrarian. You're saying, okay, it might go lower, and by the way, you should still be willing to own the stock, because you might end up owning it.
Very, very likely you could be.
Yeah.
Just as a final thought, where is rail? Has that done anything, or is that still
actually
languishing? Very
interesting that you brought that up. They dropped one day by about 8%. This is totally speculative. Okay, this is a speculation.
Right.
When this company is selling at such a cheap price, I mean, it's unbelievable how cheap it's selling, and it's perception. They make they get a fairly significant amount of revenue from rail cars that provide. They're providing rail cars to coal companies. You know how coal hasn't been under fire because people don't want to use it because it's a dirty fuel. It's because the natural gas prices are so low.
Right.
And China will buy every piece of coal that we can mine and ship over there, by the way.
Can you make money doing that, though?
Well, if natural gas prices go up, they're going to make a lot of money doing that.
Okay.
So that's the bet. They have very little debt. They've got a ton of cash on hand. The book value is about 15 to 20% higher. The net tangible book value, tangible is about 20% higher than the share prices. And when something like this has happened. I've seen this in the past where you get companies that will come in. A hedge fund gets an idea that somebody might buy these guys out because Trinity or what's it? Greenbrier, is that the name of it? I think it is.
Greenbrier is Chesapeake, right?
I forget what it is.
Chassis system.
I forget. Well, there are a couple of other larger manufacturers.
Van Sweringers. The vans.
Well, they could. The other, I'll have to look it up. I don't remember right off the top of my head, but there are a couple of big players in this market that could buy these guys out for next to nothing, and they get all that. These guys did close to $800 million last year in revenue, and their profits were $40-50 million bucks. So if you're going to buy that and your net cost to you is like $80 million, why would you not do that?
Yeah.
Why would you not do that? So that, and even if just to put one of your competitors out of business.
That's true. It's a very inexpensive price to achieve that.
So that's why I was talking about it to begin with. And I've seen where the volume will spike, the share price will go down a few weeks before somebody announces a takeover.
Okay.
That's happened several times in the past 24 months. But anyway,
so what happened? You said it went down by 8% in a day.
Yeah, and then it during the day, and then it closed up only down a couple percent. In the past couple of days, the volumes dropped, and it actually rose up a little bit. But I gotta run because I have to take another call here. But give me a call in the office. I'll tell you more about that. Yeah, have a good week.
Sure enough. Bye-bye.
Thanks. And right now I'm going to go to Daryl. Hey, we got a couple minutes here left, and I think I know what we're talking about here. This you're the owner of NutriSkis.
Right.
That's a website. People looking to build supplemental income might be a business opportunity for them.
We talked a couple of weeks ago, and I had a couple people check the website out, but I got accused of mumbling the name of the website.
Okay.
So it's NutriSkis.com. That's NutriSkis, NutriSkis.com. Chance for people to earn maybe $1,000 to $5,000 a month operating a mini office outlet from their home. They need a computer, a good internet connection. The website will give you a couple of real short videos to take a look at. And the products are just absolutely amazing. And that's the unique part about it. The products are consumable, and you can't buy them anyplace else. The company takes care of all of the marketing and the shipping. So all we got to do is tell people about it. So that's the story. It's NutriSkis.com.
Okay.
Did you have any other people talk to you about it?
Actually, just the one gentleman that called you, and I told him exactly how I felt about it. I used the one product every day. I think it's a great product. They have a lot of products to choose from. I just haven't gotten around to. Actually, I like the one that the disinfectant, the wipes, the antibacterial. That one actually smells really good and tends to work really well too. So, but anyway, I got to let you go because I'm running out of time here with my show. But have a good week, everybody. Thanks for listening. I'm here every Saturday morning from 11 to noon. This is Bill Bullington. This is called the Bullington Capital Report. You can go to my website to find out more about our firm or sign up for one of the seminars. There is no cost to attend ever, but seating is limited. That's bullingtoncapital.com. Just click on the seminar site. Next one's coming up in August. It's a Saturday morning, August 13th, Saturday morning, 8:30. Continental breakfast. Come and hear what we're talking about here every week on the radio. And I think I still have some extra time here. I take that back. Gotta go. Have a good week, everybody. Good luck and good investing.
Product made reference to, directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.